The $400 billion warning. Why Warren Buffett is liquidating everything. While retail investors are aggressively chasing the artificial intelligence hype, sending Wall Street to historic, record highs, the most successful investor in human history has quietly stepped away from the table. As of mid-2026, Warren Buffett's Berkshire Hathaway has quietly accumulated an unprecedented record-breaking cash hoard of nearly $400 billion. He isn't just trimming his portfolio, he has net sold equities for over 3 consecutive years, systematically gutting his most prized positions, including his beloved Apple. The Oracle of Omaha has officially moved nearly 60% of his entire investable portfolio entirely out of the stock market. Why is the greatest value investor of all time aggressively liquidating his positions right now? The truth is, he is quietly executing 5 unbreakable rules of survival, and his multi-billion-dollar exodus contains a terrifying warning for what is coming next. To understand the sheer scale of what is happening, look at the data. Berkshire Hathaway's cash and short-term US Treasury bills have swollen to a record $397.4 billion. This massive mountain of dry powder represents a direct historic vote of no confidence in the current economy. This cash hoard is now larger than the entire annual gross domestic product of countries like New Zealand, Norway, or South Africa. Even as Buffett officially hands over the CEO reins to his successor, Greg Abel, the mandate remains fiercely defensive, raising the flag, "We will not force capital into overvalued assets. Wall Street wants you to believe that the AI revolution has created a permanent, unstoppable bull market." But Berkshire is liquidating assets because Buffett is tracking 5 critical warning signs that the average investor completely ignores. But what exactly did Buffett see in his favorite valuation metric that forced him to start selling? The answer lies in his most famous mathematical indicator. Rule 1. Never ignore the macro yardstick. In 2001, Warren Buffett revealed his absolute favorite metric for evaluating whether a market is safe or a ticking time bomb, the Buffett indicator. It's a beautifully simple formula. Take the total market capitalization of all US publicly traded stocks and divide it by the nation's nominal GDP. Historically, whenever this ratio crosses above 100%, the market is considered overvalued. When it crossed 140% during the peak of the 1999 dot-com bubble, the market violently collapsed. Today, the Buffett indicator has shattered all historical precedents, screaming past 227%. The total value of the stock market is now more than double the entire productive output of the United States economy. Buffett knows that corporate earnings cannot permanently outrun reality. When the disconnect between asset prices and actual economic output reaches a historic extreme, a violent reversion to the mean is mathematically inevitable. But extreme valuation is only half the equation. Buffett's massive liquidation was triggered by a sudden aggressive move in his single largest stock holding. A move that shocked Wall Street. Rule 2. Kill your darlings before they kill your portfolio. For years, Apple was Berkshire Hathaway's undisputed crown jewel, making up nearly 50% of its entire equity portfolio. Buffett publicly praised it not just as a stock, but as one of the greatest consumer products businesses in the world. Yet, Buffett systematically broke his own holding forever mantra, aggressively slashing his Apple stake by over 2/3. While retail investors bought the tech hype at all-time highs, Buffett looked at the soaring price-to-earnings ratios of the Magnificent Seven and realized the risk-to-reward ratio had turned completely toxic. He chose to pay billions in capital gains taxes and walk away with cash rather than ride an overhyped tech bubble over a cliff. He didn't care about missing out on the final euphoric legs of the rally. He cared about preserving capital. But Apple wasn't the only giant he abandoned. To fund his massive escape, he had to take down another massive pillar of his empire, and it points directly to an underlying crisis in the financial sector. Rule 3. Spot institutional fragility. Early. It wasn't just big tech that Buffett fled. Berkshire Hathaway shocked the financial sector by aggressively cutting its massive stake in Bank of America by more than half. Buffett has an unparalleled understanding of the banking system. By liquidating his bank stocks, he is signaling a deep discomfort with the structural risks hidden under the surface of the financial sector. Commercial real estate vulnerabilities, mounting credit card delinquencies, and the long-term impact of prolonged restrictive interest rates. When the world's most sophisticated financial insider systematically backs out of the very banks he rescued during previous crises, it tells you everything you need to know about the underlying stability of the system. Yet, as Buffett pulled hundreds of billions out of stocks, he didn't just let it sit idle in a checking account. He found a high-yielding, safe-haven hiding place, one that reveals exactly how skewed the market's risk premium has become. Rule 4. Take the risk-free money and wait. A common critique of holding cash is that inflation silently destroys its purchasing power, but Buffett isn't holding paper dollars under a mattress. Over 85% of Berkshire's massive cash pile is parked directly in short-term US Treasury bills. With short-term yields hovering between 4% and 5% over recent years, Berkshire Hathaway is effortlessly pulling in $15 billion to $20 billion a year in entirely risk-free interest. Think about the brilliant simplicity of this strategy. Buffett is looking at an incredibly expensive stock market and realizing that the potential reward of buying overvalued equities does not justify the immense risk. Why risk billions chasing a volatile 8% or 10% return in an overextended market when the US government will hand you billions completely risk-free just to sit on your hands? But this massive pivot to treasuries isn't just a defensive bunker. It is actually the ultimate offensive setup for a phenomenon Buffett has capitalized on during every major economic collapse in history. Rule 5. Treat cash as a loaded weapon. Retail investors view cash as missed opportunity. Warren Buffett views cash as the ultimate strategic weapon. He famously calls his cash reserves an elephant gun, a massive war chest kept completely ready for the exact moment a market dislocation occurs. History proves this. In 1987, when the market crashed, he stepped in to buy Coca-Cola at a generational discount. In 2008, during the Great Financial Crisis, he fired his elephant gun, deploying tens of billions to secure highly lucrative, preferred terms with Goldman Sachs and General Electric. In 2022, when the market dropped, he instantly deployed over $50 billion into energy and financial stocks. Buffett has noted that today's market behaves less like disciplined allocators and more like a high-stakes casino. When panic inevitably strikes the casino and liquidity completely evaporates, the man who holds the cash dictates the terms of the entire financial world. His $397 billion war chest isn't a retirement account. It is a loaded weapon aimed directly at the next great market crash to sweep up everything in sight. The takeaway from Warren Buffett's massive liquidation isn't that you should panic sell your entire retirement account tomorrow. You're a retail investor, not a multi-billion-dollar conglomerate. You have different time horizons and different financial goals. However, the ultimate lesson the Oracle of Omaha leaves us with is the absolute necessity of strategic discipline. Audit your exposure. Take a long, hard look at your portfolio. If you are heavily overextended on high-flying speculative tech stocks or trading on high margin, you're gambling, not investing. Build your own war chest. Ensure you maintain an allocation to patience. Having liquid cash or short-term, yield-generating instruments gives you the psychological peace of mind and the physical capital to buy generational opportunities when everyone else is panicking. Value over hype. Never let FOMO dictate your financial future. If the math doesn't make sense, be completely comfortable sitting on your hands. As Buffett has famously reminded us for decades, be fearful when others are greedy, and greedy only when others are fearful. Right now, the smartest capital on earth is very, very fearful. If you want to navigate this changing financial landscape with data and deep dive analysis, hit the subscribe button and turn on notifications. Leave a comment below. Are you holding cash right now, or are you still fully invested in this market? Watch our next deep dive breakdown right here, and we'll see you in the next video.